Hi, this is Simon with Trade and Perform Coaching, reviewing Friday's trade from October 4th, 2013. Just a quick note, this is for educational purposes only. Nothing in the trade review on the blog or in my Twitter feed should be considered a trading recommendation. Trading futures is dangerous, and you should consult your financial consultant and make sure that trading futures is appropriate for you. So, let's kind of look into what was going on in the day and some of the basic concepts of my trade plan and see if that'll help some people out kind of understand it. So each of these levels is a resistance point, okay? The whole thing is from front to back or vice versa. When the market approaches the zone from underneath, the front of the zone would be the bottom of the zone, and then the back would be the top of that zone. If it approaches it from the top, then the front of the zone becomes the top and the back of the zone becomes the bottom. Before it's penetrated, it's resistance. After it's penetrated, it's support. The objective in using those zones is it's an ideal place to look for good trade location. The location itself should provide an edge. It doesn't mean that it'll simply stop at that point. What it does mean is that somewhere in there you should see at least a pause and or a good rotation lower. So news environments, normally when news comes out, it's scheduled 8:30 in the morning, 9 a.m. You have a release of oil numbers that usually comes out at 9:30 a.m. But with the recent issues going on with the Congress and the shutting down of essentially all government operations except the most essential, and going back to the war or potential war we had in Syria, news of that nature causes fear and supersedes the zones. It also causes a great deal of amount of anxiety within a trader. No one wants to get ripped to the downside, right? So your protection from getting ripped by news is your stop loss, right? And in any stop loss, you have to make two decisions. Your first decision is the stop loss appropriate for the trade you're in? Number one. Generally, my stop loss is 2 points behind the zone in general. And so that can end up being, if you only take the trades in the back, 2 points from behind and 2 points from the front. 4 points from the front. And that applies both to the first time it's touched and the second time it's touched. Now, you also have to pay attention to the size of the rotation in the market. Generally, if you only have a 2 or 3 point rotation, you don't want to take a counter trade. Even though they can work, your odds are lower that they'll stick. Why? Because you want to either enter the market where buyers are exhausted or sellers are exhausted for your largest opportunity. The second part comes from structure. How do you exit a trade? You generally want your trade, in order to reduce anxiety while you're trading, you want your entry structured, you want your stop loss structured, and you want your exit structured. All three of those. Now, how you structure them depends on your strategy and approach, your ability to take risk, and what your overall targets are on a larger sense. If you're swing trading, you're probably going to have larger targets and larger stops. If you're scalping, you're probably going to have smaller stops and smaller targets. However, if you're scalping an instrument like ES and you're trying to do it with less than a point stop, due to the natural rotation in ES, you're highly likely to get tagged unless you have the skill ability to consistently hit the exact low or the exact high. And very few people have that ability. So what ends up happening is you enter a trade, you put a tight stop in, you come in, you get tagged out, and then only to watch the market go in the direction you had chosen originally. And it can be very frustrating. The counter to that is, well, my stop is so large that I'll end up losing money if I take a 2 or 3 point hit or 4 point hit. How do you counteract that? Well, what you have to know before you put in your stop and what kind of targets you're going to use is how often and how effectively can you target those areas. In other words, if you take that trade 10 times, how often will the trade stop you out? You need to know that before you can take the trade in succession, because If every trade is a life or death situation for you, right, you'll always be on edge and it'll become very difficult to have any type of trade plan. If, on the other hand, you know that out of 10 trades, you'll be able to successfully navigate that trade out of, let's say, 7 out of 10 times, then you'll know net over the course of 10 trades, you will have a profit. If you don't know that up front, then you have to hang on every tick. And that leads to overtrading. It leads to high levels of anxiety and stress. And when you're at that level, you miss the meta communication that the market is sending to every trader. So with that being said, and kind of giving you the outlines, if we look at Friday morning, the market opened up, and it originally came right up into this 1673 and a quarter, 1675 and a quarter. Now, my thesis on the day was actually that we would push lower because it appeared that Congress was not going to resolve their issues, and they did not. However, my thesis was wrong. What were some of the clues that my thesis was wrong and I needed to flip in the other direction? Well, first of all, my short at the top of this zone when we first at the bottom of this zone when we first entered gave you a 2-point rotation lower. That's the first thing that, it's actually the first scalp that I took of the day, and the trade worked perfectly. It was also the first touch of the zone, okay? And the focus is on the first touch of the zone. Now, there's a debate constantly within my head, which is if the body of the candle did not close in the zone, is it the first touch? It depends on your risk parameters. Technically, this was the second touch. The risk is after it's touched the zone the first time that it'll blow through the zone, and that's exactly what happened here. So next thing to notice was that when we opened, we did not even attempt to hit Globex lows or gap fill. We came close, but we were unable to do so. So that's a sign of strength, number one. The next clue was that we did blow through this zone very strongly. So that's a sign that buyers are very interested. The other piece that I found very interesting was and let me see if I can find it quickly, was the overnight clues. Okay, so if I'm looking overnight, the first thing that I notice is that we are going through, first of all, this is where we closed, and from where we closed, we came down and tested, but never traded lower. In addition, the highs were getting consistently higher through the course of the day. This is the first swing high, second swing high, and while they came back down and constantly did a test and retest, we never really closed. We came close here, but we never closed below the prior swing high. And so that in and of itself is a sign of strength. And this is where the market opened right here on a 15-minute chart. We had the initial hesitation to the downside, but we never closed below, or at least much below, this last swing high. And so at any rate, the point of that is that there was structure indicating that buyers were in control. So my theory simply might be wrong. And at that point, I need to go, okay, that's good information. How can I flip this to my advantage? And the way that I do that is I have a couple of tools that I can apply. The first one is, if the market is strong like this, I can simply choose to look for pullbacks and entries where I will have a swing long. The next choice is, in addition to, if I want to play to the short side, I need to look for tick divergence, tick extreme, or a combination of the two, meaning I'm getting a divergence in price and tick, or I get a tick extreme reading followed by new highs that would create a tick divergence. Either way, all three of those would end up being setups. And so not all days are going to be layup days to the short side, and there really was no clear-cut short entry besides using tick extreme. However, if you did use a tick extreme, and this is when we hit about an 800 positive tick, it did give you good trade location to the downside and paid you a minimum of 2 points. Now let's talk about scalping a little bit. When you're trading, if you're applying if you're planning to take, let's say, a 10-point trade, right? You enter your position with perhaps 3 contracts. Well, if you're not scaling as the trade's going in your direction, you constantly stand. In other words, let's say you shorted here and you said my target's 10 points lower. If you didn't scale at key points as this was coming lower, you ended up getting stopped either break even or you took a stop for a loss. And in an environment where news is constantly coming out and could either sink you or really give you a very large target to the downside or to the upside, depending on which way you're trading, you have to be flexible. And the way to be flexible is to plan your structured exits. And whether that's at one point or every other point where you're exiting, scaling to some degree certainly helps getting the P&L in there, and it makes it easier to hold the last parts of the trade for your ultimate target. So that's kind of how we approach the day in terms of the management of the trade. So it's been a little while since I've done a trade review. This week got really burdened and that was really quite difficult for me for personal reasons. So at any rate, long story short, we did end up with a trend day up for the most part. We closed near the highs on Friday. Now, I don't know if the hope was that they're going to resolve an issue and then, Monday everything would be all right. But I do know this. There's been consistent buyers on dips. And until I see that end, I have to be cautious on the short side. Particularly on Thursday, we saw the market pretty much come, not all the way back, but a tremendous counter rally from the lows back up to the midpoint, which was almost 14 or 16 points. Somewhere in that range. And even though we backed off the end of the day, we continued higher on Friday. So those are clues to me that buyers are looking for an end to the market. So until I see that change or that signature change, I will continue to, at this point at least, be cautious on my shorts and have to have them work perfectly and take scales. I made an error in not taking my scales on Thursday, and I left a really, really big trade on the table. So going into this week, I'm aware of certain things. First of all, we're still in a news environment, which can rock you one way or the other. Secondly, it appears that every time we have a dip, that there will be counter buyers, at least to this point, willing to drive it back up. So I'm going to be aware that when we get good extensions in the market, I want to look for longs. The third piece is if I come in with a piece of data in the day, let's say there's bad news prior to the market and the market gaps down. I want to have these things verified for me by the way the market's trading, meaning A, was there a gap fill or lack of gap fill? B, if I'm expecting a strong open, is the tick negative or positive? If the tick's negative but we get a big gap, that's a clue that we may not continue. We may not have an opening drive. The third part is trend days up tend to have strong tick. They tend to have an open drive early in the market, and they tend to have very small counter rotations, both on the upside and the downside. So those are all clues that can kind of help you feed in to a trading strategy. The last part that I would recommend is if you're trying to jump around and pick different trades, one's a swing trade, one's a scalp trade, lots of traders do this, and it really ends up hurting them because they end up with constant regrets. I sold this early, it ended up being a trend trade. I tried to hold this for a trend trade, it came all the way back against me. You've got to know who you are as a trader, number one. You've got to have a strategy, and that strategy should be written down, executed, and then checked at the end of the day, correct? And then you should be taking the time to master one trade that you know you can hit over and over and over again. And there's no one edge that can't be mastered and can't be used to make a lot of money. Where the problem comes in is that no one takes the time to build structure or strategy, or very few, I should say, to build a structure and strategy to execute and extract profit from that edge. And so you're still left kind of aimlessly out there trying to figure out what to do. And what that ends up doing to traders is it ends up leaving them floundering. And they end up with weeks that are profitable, followed by weeks that take all the profit back. So I certainly hope the video helped. I'm a little rusty at doing them, but I'll be back on track this week. My name is Simon with Trade and Perform Coaching. If you have any questions, feel free to drop me an email, hit me on Twitter, or on StockTwits. I hope everyone's having a great weekend and hopefully a very profitable week to come. Have a great day, guys.